Now let's talk about the flattening of the yield curve from the UK to Indonesia. Global bond investors have been joining their US counterparts in driving yield curves flatter. Federal Reserve rate hikes kicked off the trend, but now other central banks are also tightening policy, and developing economies have had to act to support sliding currencies. But what does this mean for your portfolio? Jub Hurren, fixed income manager at Aviva Investors, is still with us. Now we'll go global in 1 second, Jub, but let's just stick to the US story for just a moment, because I didn't do enough on it in our first conversation. The yield curve continuing to flatten. We show that on this classic chart here. This is showing 5s, 30s and 2s, 10s, both flattening. I've had many different interpretations as to why this matters or whether this tells us anything about a recession looming. Do you think it does, or do you think it just tells us about the need at certain parts of the curve for certain types of investors to be buying fixed income?
Yeah, I mean, everyone focuses on this chart so much because it's been a reliable indicator of future recessions. It has done that with a very variable lag. So typically when the yield curve inverts, it can be anywhere between 6 months and 2 years before we end up in a recession. We caution that things are a little bit different this time, and the reason for that is the central bank policy that we've seen post the financial crisis, which has been widespread QE. You know, they've been buying this asset class in vast quantities. That to us has a dampening effect on lots of things, lots of risk premia within fixed income, and one of them's term premia, or the natural steepness of interest rate curves. That's now deeply negative, and that causes a very flat curve. So that's one thing that we think is possibly keeping the curve flatter than it would be otherwise. And obviously the interesting thing now going forward is that policy is largely coming to an end. So the Fed are actually winding down their balance sheet, and the ECB are stopping QE purchases at the end of this year. So we think curves should be naturally steeper.
But does anything change this? Does anything stop this from being the picture? So do I get to talk about some steepening of the curve at any point, or does it? and does it stop short of inversion?
Well, so the Fed's actually been quite vocal on this topic of inversion. It kind of makes us think that it's quite possible that as we get close to inverting the curve, they'll try and take some measures to maybe slow things down, because I think they're as worried as maybe some other market participants that this is a signal of the next recession. You know, I think the key thing that could change here is the Fed's estimates of their long-term neutral rate. So one of the reasons why long-term bonds, really anything past 5 years, is pinned at about 3%, is because that's where the Fed have signalled their estimates of the long-term neutral rate are. So in some ways, they're actually signalling that the curve should ultimately flatten and then invert by the path they've laid out in their forward guidance. So that long-term neutral rate is a number that's come down by about 100 basis points or so over the last 3 years. And that was as the Fed bought into this concept of secular stagnation. Inflation is going to stay low forever. Interest rates need to stay low forever as a result. That looks a little bit broken now, because inflation is really starting to accelerate in the US.
Yeah, you know, PCE we talked about,
PCE is at 2. Headline inflation is at 2.8 or so. You know, we're well in the realms of a higher inflationary environment now. So the possibility of that long-term dot going up, we actually think is pretty likely.
And because of the role of the US Treasury market and the size of it, how infectious is what's going on in the United States into other markets? I've got this chart which shows the UK, India, Australia, curve flattening going global is the nice title of it. And it suggests that this flattening phenomenon is something that is happening elsewhere.
Yeah. Well, so the currency is the key variable here, if you like. So specifically with emerging markets like Indonesia and India, they've been hiking interest rates largely to protect their currency. You know, as the Fed tightens policy and tightens liquidity conditions, that attracts capital away from places like emerging markets back to the US. Now, if the emerging market economy wants to protect its currency, it also needs to try and keep you know, a similar pace as the US in terms of hiking interest rates. That will also flatten the curve for those emerging markets as well. So it's really a currency effect that we've seen, and it's quite symptomatic of this kind of late cycle behavior where developed markets tighten interest rates. Emerging markets normally come under a bit more pressure and have to take these kind of monetary policy steps to calm the fixed income market.
So it's all clues are in the dollar then, are they? We keep an eye on the FX markets and the dollar moves and whether it continues to strengthen.
I mean, that's really been the key driver, certainly in the short term, but even last year, you know, we're in a very soft dollar environment. It's been great for emerging markets. As soon as the dollar started going up this year, that was when emerging markets started selling off. Now, it's a bit of a misnomer that this sell-off in emerging markets is all about trade wars. Some of it is, but only very recently. Now, if you look at the performance of countries like Argentina and Turkey, they're not major exporters, specifically to China or to the US, but they've sold off a lot this year. That's really been a story of tightening financial conditions in the US, a stronger dollar, putting pressure on those economies that have borrowed a lot in dollars. You know, so we think that's been more of a driver of the sell-off in EM.
Jub, great to have your thoughts this morning. Good to see you. Jub Hurren, fixed income manager at Aviva Investors.